Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Indian stock market are likely to see more amount of recovery after previous sessions drebbing. Talk about GIFT Nifty, it's indicating a flat start coming in for the Lal Street, 21,700 mark, beg your pardon, aside. The Nasdaq scored in the first gain of at least 1% in 2024 on Monday. Fall in treasury yields help lift mega stocks. Talk about Asian market, well, indices were mostly higher, at least the last time I checked on Tuesday, after a tech-led surge on Wall Street. Essentially, globally, investors await the next set of US inflation numbers, which is due this week, which could perhaps hint at the Federal Reserve might just start cutting in interest rates. Talk about FIIs, they've bought shares to an extent of 16 odd crore, and DIIs have purchased equities to an extent of 155 odd crore. Well, that's that. When we have the entire trade setup there for you. Of course, let's also get on to the FNO ban. What is, the few stocks that we need to watch out for. But the Nifty PCR ratio at this point of time is around that one level. But let's get going with the strategies, levels and the top recommendations of the day with Aamar Singh. Good morning there.
Yeah, very good morning.
All right, I'm going to start off by asking you about the immediate support and resistance levels now for the market after the previous session dropping that has come through, at least in the second half. Do you sense some amount of recovery perhaps for the Indian equity markets in today's session? How does the week also look like?
Yeah, so if you look at the major indices, we have seen some sort of consolidation happening there, and also on the daily charts we've been seeing a tapering off of the momentum, and that is quite visible not only in Nifty but as well as in Bank Nifty as well. So that really, and if you look at the major heavyweight stocks, there also we are seeing a similar pattern. But overall, as I've been saying for quite some time, overall the long-term trend, intermediate-term trend, the momentum continues to remain strong and firm. Also, if you look at the OI data, we did see some long unwinding happening, but there's not huge short built up in that sense. Looking at the levels to watch out for, I would say Nifty on the downside, 21,450, 500, that's an immediate zone of support, and on the upside resistance around 21,750, 21,800. So any correction should be used as a buying opportunity, but one should remember that it is likely to consolidate in this range. If it starts trading below 21,000, 350, 400 levels, then and it sustains below that level, that means further selling could be there towards 21,200 to 50 levels.
Sure. Also, 2-3 stock recommendations for the day. Of course, auto stocks are expected to be in focus after the Bajaj Auto buyback that has come through, and it's a big one. Promoters are also expected to participate. We're going to be talking about that in just a jiffy. But apart from that, anything that looks good on the charts right now?
I would say Century Textiles definitely looks good because despite the market witnessing some correction, the stock has been trading strong and firm. Even on a monthly basis, the stock is up by almost 24%. Last 3 trading sessions have been very positive for the stock. So this is one stock one can definitely look at. Currently, it's around 15, 18 levels. So any pullback in the stock can be used as a buying opportunity on the upside. The target should be around 1565 levels. The second stock to look at is Unichem Laboratories. Excuse me. This is again one stock which is quite strong technically on the charts. One of the stocks which has broken out of a consolidation zone above 440. That was a major zone of resistance. So that has been taken out. So any pullback in the stock towards 450 odd levels can be used as a buying opportunity with a stop loss of 427 and a target of 487 on the upside.
All right. How about Bajaj Auto? That's the one that we need to watch out for clearly, along with the bunch of auto names, of course. But first with Bajaj Auto.
Yeah, Bajaj Auto is in a different trajectory altogether. It has, in spite of the market, some correction, the stock has been in an up there, and I would say currently also the stock is displaying a strong uptrend. Also, the best part is that it continues to remain very strong across time frames. The momentum isn't dying or the momentum isn't declining. These are two important points. The momentum isn't dying nor is it declining. So that tells me that, and that from a medium term to long term perspective. The stock now has got strong support. The support base is around 7,000 levels, 6,800, 7,000 levels. On the upside, the stock has a potential to rally towards the 7,500 mark. However, what we are seeing is that increased volume is being witnessed and delivery quantity is being witnessed at these levels also. So that tells me that some distribution as well is happening, but at the same time, some money is also moving to the stock. So overall, the trend remains strong for the stock. So those who are long, they should definitely hold. For fresh entry, they should wait for some correction, which is not unfortunately happening in the stock.
Aamar, I'll also want to chat about Bandhan Bank, but that's of course after addressing in the market open, a bit of drubbing that came through to Bandhan Bank. Perhaps some recovery could take place, but we're going to be addressing that in just a bit. We are looking at gains coming for the markets, just like how we anticipated, 21,600 and flirting around that 21,000 or nearing around that 21,650 level. Talk about the Bank Nifty, 47,650 mark with gains to an extent of 0.5% there. At this time, mid cap and the small cap index also is trading higher. For mid cap index, it's gained to an extent of 0.75%, and small cap index too. We're seeing some amount of perhaps outperformance, the percent clocked even on this one. Let's talk about the auto and IT index. Typically, that's the one that we need to watch out for. Well, auto index typically, which Bajaj Auto along with that of Tata Motors. Tata Motors is coming with the updates per se, the Q3 updates, business updates. That's also one thing that we need to watch out for. 1.5% uptick for Nifty IT there, and the auto index too is doing at this point of time is doing fairly well. Let's talk in the top gainers and the top losers out there. Well, top gainers, we have the list to an extent of Bajaj Auto. There it is. It's the top gainer along with Wipro, Infosys. Well, these are another IT-led name rally that you're looking at. 1.5% uptick there. Tech Mahindra, Tata Motors, BPCL. Well, clearly it's the day dominated by IT and autos. TCS, Coal India, Hindalco too participating into the rally. Some amount of traction creeping in from the metal names as well. Talk about top losers there. Losers, we have, the list needs to be updated there. But overall, if you look at the sentiment right now, you're seeing both Morgan Stanley and CLSA, two of the most respected brokerage firms, the last read, perhaps taking in a cautious approach on Indian equity markets due to a variety of reasons, upcoming polls, cues from US market, geopolitical factors, and relatively higher valuation. Aamar, I'm going to come back to you. What's the strategy that you think we need to now adapt at this point of time? Bandhan Bank is what we were chatting about essentially after the sharp sell-off that came in on account of the development, which perhaps suggested of an audit report, which was pretty regular and preliminary in nature, but was not really interpreted well by the markets. A, the strategy for the markets now after the kind of recovery that we've seen right at the open, and B, Bandhan Bank.
Yeah, so with regard to the markets, as I said, that the markets continue to remain firm, but we've seen some sort of consolidation also. Despite the sharp up move, we are seeing that it is in a consolidation zone. So, but with a positive bias, that is, the bulls are still in strong, but from a short-term perspective, we could also expect some selling. So, as I said, 21,000 towards 21,700 levels, those can be selling opportunities because that's a 21,700, 21,800. That's a strong zone of resistance. On the downside, any correction towards, I would say, 21,500, 550, that can be a buying opportunity because the market is also witnessing increased volatility. Talking about Bandhan Bank per se, see, if you look at the stock really has missed the bus. And if you look at the entire rally, there are many stocks which have not really rallied, and this is definitely one of them. There would definitely be more fundamental reasons for that as well. Technically speaking, what I see is that the stock has got very strong resistance around the 265, 275 zone. Recently also, it made a high of 263 and then it's corrected. And as you said, that there's some report which has come in, so that also led to some sharp selling. So technically speaking, 265, 275, that's a major zone of resistance. No rally is going to happen in the stock till the stock takes out this level consistently. Then we could expect that the trend has changed from a medium-term perspective to a long-term perspective. Otherwise, the stock is in for consolidation. On the downside, I would say 220, 230, that's a good level to enter. It is on the upside. So it's a 220, 260 zone that the stock currently is trading in.
All right, Aamar, one last question. Zee Entertainment is what I'd like to chat about before navigating our conversation to a very special guest. But Aamar, come in on this one.
Yeah, so again, Z is also one of the stock which really hasn't delivered much, and we've seen that higher levels are being sold into. Technically, it's not very strong on the intermediate term trend, even the long term trend. So that tells me till the stock doesn't sustain above the 300 mark, there's nothing happening in the stock. The stock is likely to trade sideways. On the downside, the stock is again around 240 level. So it's more, the chart patterns are similar to what's there in Bandhan Bank on a long term basis. So that tells me that Z is also capped between 240 and 300. So it's more of a trading. It's a good trading play, but there's no trend in the stock as of now.
All right, Aamar, we're just going to leave it at that. And thank you so much for taking out the time and joining us, and also for all the recommendations that you've offered.
Thank you.
All right, I'm going to quickly address in the development of Bajaj Auto. It's a big news of the day. The company board approved share buyback to an extent of 4,000 odd crore at 10,000 rupees per share via the tender offer. This is at a premium of 43% as compared to the last closing price for Bajaj Auto. Bajaj Auto would be buying back 1.4% equity and assuming profit increase of 30% in FY24. Overall, company's dividend plus buyback for FY24 put together could be 8,400 crore. Also, do bear in mind the fact that this is Bajaj Auto's second share buyback in as many years. The auto major in July 2022 purchased shares to an extent of 2,500 crore from holders at a price of 4,600 a unit. UBS at this point of time has a sell rating. It talks about the buyback price being pretty steep and also says that the promoters may participate, which means that the promoter group typically potentially can receive in 2,200 crore. And also do bear in mind the fact that stock has already seen a run-up of 6% and another 2.5% clocked in today's session. Of course, Tata Motors is another one, but we're going to be addressing that in just a bit. Let's first go across to Aashish Somaiyaa, who's the CEO at WhiteOak Capital AMC, who joins us this morning. Good morning there, Aashish, and also Happy New Year to you.
Good morning, Nickey. Happy New Year to you.
And apologies for the late wishes that have come through. It's almost a week to the new year that we've started off. But just a literal perspective in terms of how are you looking at the markets right now? You have both the foreign brokerages, that is Morgan Stanley, along with that of CLSA, perhaps sensing some caution on account of host of factors, like you have the US market cues, Lok Sabha polls, and the geopolitical factors. How are you reading into this?
So, Nickey, I remember exactly similar time last year, I spoke to you and I was revisiting the conversation. So when 2023 started, we were expecting that the first half of 2023 would be quite difficult and the second half would be better. For 2024, always difficult to forecast, but if you put a gun to my head, I would say that the first half is likely to be much better, and whatever momentum we are seeing in the market, there is reason to believe that it might persist, at least till the run-up to the elections. And also the fact that, first half of 2024, I think, would be better and second half would be a little bit lackluster. The reason is that, in the first half of 2024 is when, since you alluded to the US, my sense is that second half of 2024, when people are expecting that the US would, start cutting rates. Now, we should bear in mind that cutting rates always happens amidst bad economic news, and that always tends to impact the markets. So right now, when we are talking about a pause and when we are talking about a rally in the US bonds, you can see that the dollar gives up its strength. You can see the dollar index coming down. You can see, as a result, rupee being stable and huge amount of FI flow coming into India. All of that should persist probably in the first half. And also maybe part of the year, but towards the fag end of the year, my sense is that the clouds will get slightly darker because the most exciting event for the year might be out of the way. By then, the budget also, even if it is July, the budget might be out of the way. So I think second half of the year might be lackluster, but I think first half of this year, maybe the momentum continues.
Very valid point made there. US interest rate cuts, perhaps we got to be careful of what we really wish for. And that's something that you and most of the participants across the last week need to figure in. But speaking of just the bull run that we've seen thus far, of course, you're looking at some amount of a rather tough period coming in for the first half and a little more optimistic for the second half of the year. The SIP registrations have hit a record high in December. 40.32 lakhs is the number that we're looking at. Do you think at this time, with the kind of perhaps anticipated slowdown that we're witnessing in the first half, this number could be impacted?
So typically, if you ask me, when you take the first quarter of any calendar year or the last quarter of a financial year, then people would have different priorities, at least the salaried individuals, they are looking for, insurance, and they start looking for planning for their Section 80C, and somebody might want to invest in PPF or NPS or multiple other things. So I think that the last quarter of the financial year tends to be different. And maybe it's a period when people look at different considerations for whatever surpluses that they have. Coming back to the 4 million SIP number, I think that when I read the discourse or when I follow things on social media or when I read some of the commentary, I get a sense people are thinking that all this volume or large number of SIP registrations or even the broking account which are being opened, people seem to be actually thinking that it's because of the market making new highs. Yes, some part of the exuberance, some part of the excitement for people to join capital markets, you can always attribute it to market performance. But I think that would be a short explanation. I think a lot has got to do with the fact that for ages, what demographics we have been speaking about, that is materializing now. So in my humble opinion, if you're talking about 4 million becoming 3 million, sometime 3 million becoming 4.5 million, that's a tolerable range of pluses and minuses. But I expect that new account openings, either by way of SIP or people joining capital markets by way of broking accounts, that is here to stay. For the next decade or so, it is here to stay. I don't see that changing. Yes, there can be some pluses and minuses depending on market sentiment, but that's only on the margin. I don't think that this trend is going to reverse anytime soon.
Okay, speaking of trend reversal, the inflows in Indian equity, at least the mutual fund industry, rose in December, sure, but the rally essentially, or the number was driven by the sustained preference towards the small caps. And since we are getting now towards a year which is marked by election and of course the interim budget at play, do you think small caps is not the theme, but it's large cap, and by virtue of that, perhaps passive funds now will be more, preferred over the active investing and typically even the small cap and the mid cap names per se?
So, Nickey, since you alluded to the Association of Mutual Funds numbers, and, I think the key number out there yesterday, which everybody should be proud of, was the 50 lakh crore number. And, since I have the opportunity to talk to you and to your listeners, I'd like to compliment everybody, the entire ecosystem, all our investors, the regulators, the employees of the asset management industry, all our channel partners and friends in the media, because 50 lakh crores, it's quite a milestone. Now, coming to your point about the numbers released by our mutual fund association, I think the key number out there, which I always track, is what is the inflow into equity funds and hybrid funds. And when you look at hybrid funds, in that category, I would always subtract arbitrage funds. So if you look at equity funds and hybrid funds X of arbitrage funds, I'll come to a point on small cap. But if you look at equity funds plus hybrid funds X of arbitrage funds, that inflow number was somewhere in the vicinity of 60,000 crore plus. But you know what? The net inflow for that category, equity plus hybrid less arbitrage, the net inflow was barely 21 or 22,000 crores. I'm saying barely, but I know 21,000 crore is a big number. I use the word barely because if the inflow is more than 60,000 crore and still you're left with only a net flow of 20,000 crore, it also means that there is a large number of people, who have withdrawn 40,000 crores from funds. So one number to read in that, yes, as market has kind of ground up, nearing 22,000 Nifty, some people have been taking money off the table. That is one. And then there is this contradictory trend. But on one hand, there is 40,000 crore of redemption, which leaves us only with 20,000 crore net flow. And if you keep in mind that 17,000 crore is SIP itself, then you will imagine that 20,000 crore is not some blockbuster number. But the other contradictory trend is that whatever money is coming in that small cap seems to be a very, very big component. So there is almost a dichotomous behavior out there where some investors are so bullish that a lot of money seems to be going in small cap. On the other hand, there is equal and more number of people who seem to be taking money off the table. So, that's the nature of the market. There will always be two sides of the coin.
But where's the smart money essentially betting on? I think it's the question that most of the people, especially the retail investors, would want to know. Not that it is a segment which is chasing in the smart money. We've seen that amount of exuberance in the small cap and the mid cap names in the previous year. Do you think this year is going to be a replica of sorts, or you think larger caps are the one where they need to seek the rescue?
See, there is a long-term answer and a short-term answer to your point about smart money. I know you're right now alluding to where is relative attractiveness. So yes, I definitely agree, and there are a lot of respectable figures out there who are pronouncing the same thing, that there is relatively more value in large caps, and I don't disagree with it. In fact, if you really see the large private sector banks, some of the consumer companies, some of the mid-cap IT, mid-cap IT kind of picked up last year, but if you look at long range, so if you take large cap, if you take big banks, if you take consumer discretionary, pharmaceuticals, for example, some pockets of IT companies, these are relatively better value as compared to what has been really flying in the last 2 years, which is cyclicals, PSUs, industrials, etc. So that is one thing to keep in mind. And, for industrials, manufacturing, some of these sectors, they are as richly valued as what one would attribute consumer companies, till a couple of years back. So I think that glaring gap between, different segments of the market seems to be evening out. And the guys who have underperformed in the last couple of years, clearly, maybe they are more attractively valued right now. So that's the point. Now, coming to the longer term thing, when you alluded to smart money, sometimes people say that, whether foreign money is smart money, or say SIP or HNIs is smart money. I think anybody who stays for the long term and does better than 12 to 15% compounded in hindsight, that is the smart money. Smart money, which is the smart money and who is smart, you'll only know in hindsight. Whereas, for now, you can always look at where relative value lies.
Okay, the point well taken there. But cutting the chase out there, which sectors typically you think are the sectors that now one needs to watch out for? Sure, you've spoken about industrials and manufacturing, and we've seen a couple of downgrades essentially also, which has come in on the cement space per se, specifically Ambuja and ACC, where CLSE downgraded both of these counters and prefers more towards Ultratech and Dalmia. But within the space, or also for that matter, any other theme that you think could be the alpha generator for 2024?
See, I think our team clearly doesn't do much work top down, or we don't take bets. But, if you look at alpha generation potential compared to the broader market, one in the previous part of the conversation, I did mention that in the last couple of years, the big banks have underperformed. And that's a kind of, if I follow the conversations, that seems to be like a consensus call. And consensus is not always wrong. So I think the large banks, that is one. Second is some of the consumer discretionary, some of the pharma. These are the ones where there is potential. Second is that, when you alluded to alpha, I think one of the prerequisites for any team to be able to generate alpha is not just the competency of the team, but also the fact that, are you operating in a market, or are you operating in a bunch of sectors where there is large heterogeneity amongst businesses? So if you really ask me about alpha potential, then pharma as a sector has probably the highest alpha potential, because it has a well spread across large cap, mid cap, and small cap. It is well spread across multiple subsectors like pharmaceuticals and API and hospitals and health, diagnostics and multiple other areas. So I would say that top would be financials and pharma. But since you mentioned about alpha potential, I think maximum alpha potential is probably in the pharma sector.
Pharma sector is also the one which perhaps is a little overlooked at this time when it comes to at least the market valuation. But speaking of the valuations, do you think PM Modi's likely third term is baked into the stock market valuations? Not just the third term by thumping majority is perhaps baked into the stock market valuation.
Yeah, generally, if you ask me, markets prefer visibility and sustainability. And from that perspective, a government which has done very, very well, if there are prospects that we will witness continuity, then the market is absolutely right in extrapolating this kind of economic prosperity well into the future, right? And that is what PE multiples are all about. They are all about how long you can draw the Excel, and how long are you able to discount based on the visibility. So clearly, after 3rd of December, you are absolutely right that the market seems to have already assumed that we will get a continuity. The second thing to keep in mind is that it was not just the news on 3rd December. The point is, just few weeks before that, the trajectory of US interest rates also changed. And right through, and if you see, December was not just the big month for the market. Even November, the market appreciated by a high single digit number, correct? So if you ask me, the bigger impetus for the market was a change in US trajectory. We were witnessing heavy FI selling for a couple of years. Despite a strong EPS growth, the Nifty was in the 19,000 range for a very, very long time. So after the US trajectory changed in November, then we saw what happened on 3rd December. And that is why I think there is some amount of excitement in the market. As I said earlier, because of India's strong domestic performance, I don't see there. Right now, from what I can see, there are not very many reasons for this momentum to suddenly break down. It's just that maybe second half of the year is when I expect that some headwinds might come up. Plus the fact that the big event will be out of the way, and there'll be much lesser to look forward to, and that's when markets kind of take a breather.
All right, Aashish, second last question that I have in my mind here is want to understand, we've seen 8 consecutive years of gains for equity markets on sustained basis now. The last year was a number that we looked around 20-odd%. With this year typically being an election year, you think investors at this point of time should be moderating their expectation as compared to what they've seen in the previous year, because most of the positives seem to have factored in? That's one. And also, what are the wall of worries for you which you think can throw off the projections perhaps that you have in your mind?
Yes, look, one is that, in my humble opinion, people should not read too much into what happens between 1st January to 31st December of any year. I mean, if you look at, for example, you look at 2022, the year was, beginning was quite okay, but by May 2022, we were down to 15,200 Nifty. I mean, the year could have just ended that way, but it's just that by November, there was a rally, and, we closed the year by a small number positive. Then you roll over into 2023. By March, we were down to 16,600. And for a good part of the year, market was lackluster. And then suddenly in November and December, we pulled up some 12-13%, if I'm not wrong. So look, you should always look at 1 year rolling data rather than looking at calendar year. I think each of the last 8 calendar years being positive is just 8 discrete periods. I don't think that, frankly, is very, very relevant. In the last 8 years, if you look every day, what was the 1 year return on index, you will find very many observations which were significantly negative. So I don't read too much into 8 calendar years. One should always look at rolling data and then look at the average and the standard deviation of how the 1 year number. I suspect that for a longish period, the 1 year rolling number will still fall somewhere between 12 to 15% or between 10 to 15%. And that is not changing dramatically. So that is one. And the second thing is, okay, what is the worries that one really is looking for? So one clearly is that right now market seems to think 90% probability that not only we get continuity of government and we get it with a strong performance. But look, even between now to the next 5 months, there are many things which we can't foresee, but there could be some events or anything which can happen. So investors, or human beings in general, we must always be probabilistic. We should not be too deterministic. Right now, people are definitely probably being too deterministic. So if you're overexposed to small cap, if you have requirement of money down the line, but you're still fully invested into equity, I think these are deterministic things which people are doing, and that they should be really careful. We should always be probabilistic. The second thing, like I already alluded to in terms of risk factors, right now everybody is happy that the US interest rates have let up. And people do think that in 2024 there'll be rate cuts. But past experience shows that rate cuts always come up amidst severely deteriorating economic news. And sometimes deteriorating economic news is also accompanied by some kind of financial accidents. So I think that this is something which we should not discount. The third thing is that for now the geopolitics has cooled off and there is no escalation. But God forbid there can be escalations of that also. And lastly, I'll tell you, black swan by nature is a black swan. It cannot be predicted. That is why we all have to, respect asset allocation, respect risk, and we should be probabilistic in our thinking.
All right, Aashish, have I missed on to your projections for FY24 or is something that you wouldn't want to talk about?
No, see, I think in any normal year, one expects, over a longish period, you expect the market to track nominal GDP, right? So in any normal year, you expect market to appreciate low double digit. It's just that equity returns are, non-linear and they are lumpy. So that is what actually is the holy grail.
All right, Aashish, 30 seconds on this one, completely running out of time. But corporate earnings, what's the growth that you're anticipating and where is the surprise essentially going to come from for India Inc.?
No, see, frankly, if you ask me, last couple of years, the resilience has surprised people. I think right now, mid-teens is the kind of expectation. And I think that is what the market should really, or, investors should really think about.
And the surprises that you think will come from which sector for this?
See, I think there is a rotation now. So clearly, if you take the early part, if you take 2022 or early part of 23, maybe it was metals and cyclicals. If you take off late, it has been more the banking and financials. So I think rotation is the order of the day. My sense is financials will tend to contribute more going forward.
And within private sector banks and PSU banks, the big banks, what do you like?
So if you see, for example, generally our leaning has been to the large private sector banks. So that is where we think, more value lies.
All right, Aashish, we're just going to leave it at that. And thank you so much for taking out the time and having this conversation with us.
Thank you.
All right. With this, it's a wrap and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. And for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.